It was almost like I could start singing "I've Been Everywhere, Man." I'd start singing that song. One of the jobs probably one of my very first jobs was working for a neighbor down the road who grew pedigreed seed. And this was in the days of West Star Canola. For those of you who might remember West Star Canola. Yes, thank you. And so we had to, there's a whole bunch of us kids, and we had to get on our hands and knees and crawl through the field roguing out mustard out of the canola. So that didn't discourage me. And yes, my first year of farming was 1988. My wheat went 2 bushels an acre. So I understand what drought means. And that year, I remember my dad I was telling my dad, geez, I'm looking at this crop insurance bill. I don't think I want to. He says, yeah, you need crop insurance. He says, I can do without it, but you definitely need it. And so thankfully, I did that, managed to survive for a couple more years. And then, my oldest brother said, it's either time to whatever or get off the pot. And so I had a job at UGG then already and decided he would do the farming and I would try and tell him what to do. And he's done better than I have. Let's just put it that way. So anyway, today we're going to look at the canola and barley markets. The way that I like to think of it is not in terms of predicting the future, because, as John Gormley said, I'm not going to tell you what the future is because it's the future. And so we like to think of it in terms of providing reconnaissance. So we're out there looking for stuff as far as we can see, but we don't try to go beyond that and guess what might happen that we really don't have a clue about. I think the idea of predicting markets is vastly overrated. And so we do reconnaissance. We're out there scouting around for people who would rather not do it or don't have the time to do it or just don't feel like doing it. So that's kind of the way that I see our role. And so we're going to look at the rest of this year because, as I was telling some people at break, we're only halfway through this marketing year. We still got 6 months ahead of us before the next crop really hits. And so we need to look at that and then look ahead to what's going on in the next year. So that's what we're going to do, and today we'll talk about canola and barley. I'll try to have a bit of time at the end as well, too, if people want to ask questions about other crops, because my partner and I, between the two of us, cover 16 different crops every week, so we'll try to do that as well, too. So starting with canola. So this was last year's, the 2022 crop. So acreage was down a little bit from the year before, but of course production was up. The yield though was just under 38 bushels an acre, and so that was actually a below average yield. And there were all kinds of issues during the growing season. We heard all kinds of things going on about, especially further west, about crops not coming up, not emerging, not looking good, even though the weather was okay, but they were running into some problems. And so the crop ended up, StatsCan said it ended up around 18.5 million tons, give or take. And so there are other ideas that it's actually larger than that, and I would agree with those. But right now we've built in these StatsCan numbers into our estimates. One of the reasons why we think in terms of higher production is because these are the StatsCan production estimates over the last 10 years. So they do one in August and in September. Those are those remote sensing ones, those satellite vegetation map ones, right? So that's the August and September one, the blue and the red. And then in December, they put out a yellow, or they don't put out a yellow, I color-coded it yellow. They put out another estimate, and it's based on surveys of, they try to nail every farmer down with a survey and get a response from them. And so that's what this December number is. But then if you look over the last 10 years, every one of those years, that they do a final later on, they'll revise it, and it can be up to a couple of years later that they revise it. And so every one of those years, it's come in higher than what StatsCan has said in December. So the pattern is there, and I don't know if it has something to do with farmers not giving them the very last bushel of what they've grown, but anyway, we're not going to go too far down that path. So then, pressing the wrong button. So then what we have this is what we have in terms of canola supplies this year. So we had a real bounce back in terms of the crop, but supplies, again, based on that earlier StatsCan production number, are just over 19 million tons, whereas the average is 23 million tons. So we're about, even if they come up a little bit with their final number, we're going to be 3.5 to 4 million tons less than average supplies of canola. So that's the first clue that there's something positive going on in the canola market. So we're looking at, again, trying to supply the same demand, but with 3.5, 4 million tons less supplies. This year, what's happened is that crush has bounced back, and so it'll probably end up somewhere close to 10 million tons, which is close to the highs that we've had in the years before the drought. You even look in the drought year that the domestic crush didn't drop nearly as much as exports did. So the canola crushers, the domestic crushers, had much stronger demand, much firmer demand for canola, and that's a positive signal for what's coming down the pipe in the next 3 years as more crushers added. And I'll talk about that kind of stuff a little bit later. But what we'll see is as exports bounce back to some degree, but not get back to where they used to be, which was 10 to 11 million tons, we're not going to be getting back to those levels yet. That doesn't mean that the demand isn't there. It just means that's about as much as we can do based on the supplies that we have. And so it's not a matter of poor demand, it's a matter of lack of supplies, which is good for the market. In terms of canola exports, so this was the drought year, of course, so we really only have supplies to do this much exports this year. And so the strongest buyers are normally Japan and Mexico and the US. And actually exports to the US this year are up again. The U.S. has been really, really strong in terms of demand, and that's going to continue down the road too, as this clean fuel standard and renewable fuels, renewable diesel, they're going to continue to be in there as big buyers of canola. But what happened is China was the real drop-off. That's this yellow bar here. China was the real drop-off in 21, and it looked like, or has looked like, they're not going to be back in for their full purchases again this year. Again, we simply can't do that much. But these are canola imports by China over the last couple of years. Look what's happened just in the last 2 months. You know, it went down, 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 and they used to buy more canola from Australia. That's the red bars here. Now it's almost all Canada, with a bit of Russia is the green bit on the top. But all of a sudden, they're back in buying large, large volumes of canola. So is that going to continue to push demand more demand into the second half of the year? China really is a key, and it's also a preview for the barley outlook too. But that's the surprising thing about the next little bit. And so that's to the end of December. We'll see how things continue to roll. But China really has been buying big volumes of canola. In terms of the Australian crop, so Australia is expected to grow a record canola crop, somewhere in excess of 7 million tons. And this is the last official estimate. The harvest results that they're getting now are probably going to push that even higher yet, with some exceptional yields. So they've had some strong yields the last 3 years, but they have been boosting acreage as well too. And so it's a record crop this year. But it's a trend toward higher production in Australia. So you know the saying about high prices curing high prices? Well, the Australian farmers are trying to do that as well too. They see the strong prices, they're trying to capitalize as well. In the U.S., record crop again in the U.S. this last year, with some pretty decent yields. But again, acreage over the longer haul, the acreage is trending higher. So there's trends toward more production in the U.S., Australia and in the U.S., and then the other one, of course, that we watch is the Black Sea. So this is Ukraine and Russia together. And so Ukrainian rapeseed production, so this crop here was planted before the Russian invasion. It's winter rapeseed there. So it was planted before the invasion. And so they managed to still pull off a crop almost, or a little bit bigger actually, than the year before. And so again, you have them trying to grow more, and the winter rapeseed that's been put in the ground this fall in Ukraine, they're talking about keeping acres at least that high. The winter wheat acres dropped off, but there was much more incentive for them to grow rapeseed. So they're planted similar, or maybe even a little bit higher winter rapeseed acres for this next year. And then, of course, Russia is boosting production too. So, a record crop, but it's also a trend. So in all three of these regions, Australia, the US, and in the Black Sea, you have this trend toward increasing rapeseed canola production. And so that's something that's counteracting, offsetting a little bit the drop in Canadian supplies, but still not enough to in my view anyway, to really damage the price outlook. So by the end of this year, with all of that strong demand, the strong crush demand and the strong export demand, we're going to end up with very low ending stocks by the end of 22-23. So maybe a little bit better than the drought year, but not a whole lot. So we're going to be really tight by the end of the year, and that's friendly for prices, simply put. So even with these other bigger crops, the demand is going to be there large enough to really draw down Canadian supplies. So again, we're halfway through the year right now. In terms of canola futures, so these are canola futures over the last while, and it's kind of interesting. I went back, quite a few years, or a little more than 15 years. This little section here where prices were $250 a ton. Yikes! That's when I did my first market outlook for Informa Economics in front of a bunch of farmers. Boy, that was a sad-looking crowd. But it really had nowhere to go but up from there. But we really then in the teens, if you fast forward, we had a lot of volatility, or what used to look like a lot of volatility, and then we kind of settled into this range in and around $500 a ton for quite a number of years. And the lows and the highs in those years, really the range was about $50 a ton. So we really didn't see a whole lot of fluctuation. And then, of course, prices started to do this. This isn't simply a drought issue. Canola prices were already strengthening before the drought, so it's not just that type of an issue. It's really a longer-term increase in demand for canola, and Canada being able to supply it. So supplies were already tightening up in the 2 years, I would say, before the drought hit. And then, of course, the drought caused that to accelerate. And then that's when we got to $1,200 a ton for futures. So since then, we've dropped to a range of about $800 to $900. And last week, guys were really nervous because for one day anyway, 1 or 2 days, the price just ticked just below $800 by about $2 or $3 or something like that. And everybody's knowing it's the apocalypse, and people were worried. Well, it has bounced back this week, right? And so we're seeing some of those gains. Today, I think it was down $4 or $5. But this range here, this $800 to $900, the question I have, is that a good value, or is that overvalued, or is it undervalued, or is it just about right? And so looking at a number of the different signals, and we're going to look at a few of those signals about whether that's good value or not good value. So that's kind of the question, is can we hang in and around that level? And then we'll talk a little bit later about the longer term situation. Some of the things, again, some things we can see already, some things we can't, but we'll talk about those. So in terms of where Canadian canola is relative to other markets, so this black line here is Australian canola. And Australia's had a tough time, so that's priced in Kwinana, which is on the west coast of Australia. That's the main export area. So it's well below the market. So Canadian canola, which is the blue line here, that's FOB Vancouver price, it's highly valued relative to those other markets. But it has been there. It used to be, if you go back further in this chart, right, you see that Australian and Canadian canola, the blue and the black lines, were very, almost indistinguishable. And then you started to get into this dryness, you started to get into more and more strength. And this, I would say, there's a couple of reasons why Australian canola is undervalued. They have a hard time exporting it, frankly. China has phytosanitary barriers. It's hard. They can't get their canola into China, which is one of their biggest areas. And so then they have to price it at a lower value to try and get it into some other markets. But what this does, too, is this helps demonstrate the value of having all of those domestic crushers in Western Canada that we're saying, I'm going to bid whatever it takes because my crush margins are still looking good. I'm going to bid whatever it takes to buy that canola. And so it's helped keep those prices supported. You also have strong European prices. This is, the green is French, and the yellow line is German. So there too, they had problems with their crops in 21, and they couldn't buy Canadian canola, and they had some very, very strong demand from the biodiesel sector. And we could talk about that a little bit yet too. So Canadian canola is valued realistically or comparatively well with European, but it's still quite a bit more expensive than Australian canola. So a little bit of a risk there. These are canola crush indexes. So the blue line is what we call a board crush, so it's based on futures, canola and soybean oil and soy meal futures. And then the red line is based on actual cash values. And so they're not actually making that much money per ton because it doesn't include a whole bunch of their other costs. But that's the difference between the value of the products and the value of the seed. That's how that works. And so what you have is that, again, these crush margins were relatively, well, they looked steady or stable back here, and then they started to move higher already in 2020. Remember I said the strength in the canola market started before the drought, so that was already pushing those markets higher because oil values, especially oil values, were going higher there. But now we've got these fantastic crush margins for crushers. And so, yeah, they're buying every bit that they can get, frankly, every bit of canola seed that they can get, but they're not going to pay any more than they have to. That's their job, right? Their job is to buy it for as cheap as possible. Your job is to sell it for as much as possible. And so, we have some very good values, very good prices, but the oil and the meal side, especially the oil, and I'll show you something in a second, but this is a very good value for the $800 to $900 canola prices are very good value for crushers. This chart shows the difference between canola futures and soybean futures, so that spread between there. So if you look back a whole bunch of years, it used to top out, well, this is a little bit different, but it used to top out somewhere in around $100. So canola would be $100 over soybean futures, $100 a ton over soybean futures. So what you had then is when canola started to take off, again, even before the drought, you got up to, then during the drought, it got up to $450 over soybean prices. So it's dropped back again, back down toward this normal level. So again, I would say now canola is pretty well valued again. It's relatively cheap, frankly, based on this measure. But when you saw these kind of prices or this kind of a spread, and then you'd have somebody get up and say, well, soybeans were up 15 cents a bushel today, so therefore canola, it didn't mean anything. I mean, no, I'm not gonna disparage other people. But those kind of comments really weren't helpful at all. Like they didn't, when canola's already $450 a ton over soybeans, a 15-cent move in soybeans means nothing for canola. They were much more heavily driven by the value of the canola oil and soy oil futures. But even there's demand for canola that is simply, to use the fancy pants word, inelastic. So whatever the price goes to, there are some buyers out there that'll just buy it no matter what. And so that's what helped drive these kind of spreads. This chart shows soy oil as a share of the soybean crush value. So the output of oil is however much per ton, and then the value of that, you take that value divided by the total meal and total oil value. It's a measure of, to make it a little, whatever. It's a measure of how much oil is, how valuable oil is relative to meal. So when it goes higher like this, that means that oil is much more valuable and meal is relatively less. And so for a long time, over the last number of years, oil was worth about 30 to 37, 38% of the crush. And then again, when you started to have some of these signals, and it wasn't just canola, there were other things going on, but then suddenly the oil side of the market was worth about 45 to 50% of the value of the crush. So suddenly oil was worth a whole pile more. That's positive for canola because, of course, canola has higher oil content, so therefore that tends to support canola more so. It's dropped back to some degree. Meal has actually rallied, but it's still relatively strong. And longer term, again, when we look forward 2 or 3 years, oil is going to be the driver of that crush. And again, that's positive for canola. This is seasonal price behavior for canola. So this black dashed line here is what prices do. If you take prices over the last, I think this is over at least 20 years, 15 to 20 years. So that's what canola prices tend to do during the year, so January to December. And so here, of course, is the harvest low, not surprising. And what you see is that in 22, it really followed that seasonal tendency very closely. It doesn't do it every year, but in 22, it really followed that seasonal tendency very carefully, or very closely. One of the things I'm planning on doing in the next few weeks is to do a bit of a special report for our subscribers. And really what I want to look at is, if you were to price all of your canola here at the end of May, and you were to price all of your durum at the end of November, middle of November, when it seasonally peaks, and all of your other crops, how does that do relative, compared to over the last 10 years or so? How does that do relative to selling 1/12 every month or something like that? If you really stuck to these seasonals and just did it, what would that do for your returns? So I'm very curious. I'm going to run those numbers in the next few weeks and see what we can come up with. But what we have is, at the beginning of this year, canola has taken a bit of a counter-seasonal type of a move. And so it's done this. What is that, a head fake? I would say, yeah, probably more so than a sustained move. I think the seasonals will re-exert themselves, partly because, as we saw, the demand is there. And so those supplies are going to get tighter and tighter as we get further into the year. And then, whether it's going to hit, well, it's not going to hit the highs that we had at the end of last year, but we'll see some prices. We should see that seasonal start to re-exert itself. When we look at the next year, at this coming spring, and what acres are going to do, we're fairly cautious. We think canola acres will be up, maybe 3% or so. We've heard all kinds of things. There's pretty strong competition, I think, between hard red spring wheat and canola for acres. I think that's the heaviest competition this year. But we'll see a bit of an increase there. And so that should help, again, if we get average yields, to push production back up a little bit closer to 20 million tons. That's still not massive. And again, if we take that very small ending stocks and add it to that production, supplies going into next year are going to be tight-ish again. Not quite as tight as this year, but tight-ish again. And so it's a situation where we'll probably see we'll probably, again, this is based on average yields, we'll see prices come down from where they are now, but that's already being built into November futures and so on. So that's the kind of outlook that we have for canola production. So just to take all of that stuff and put it into a few bullets, is that Canadian supplies are still tight this year. And they're going to get tighter as we get further into the year. So that's what makes me more optimistic for the price side. Other crops from other large origins are offsetting that to some degree. Australia and the Black Sea region as well, especially Russian canola or rapeseed. And then for 23, we're going to have this competition with hard red spring wheat, but probably not enough to get heavy supplies, but more comfortable than what we have now. Again, if we have average yields. And who knows? I mean, there's dry areas already out there that we know, so we don't know how that's all going to play out, but not enough to get really heavy. And then, if we look a little bit further, and I'm going to go into this in a little more detail, is that in the medium term, we've suddenly got 4 to 6 million tons more crush showing up in the outlook. And so that raises a whole bunch of other things over the longer haul. So let's look at that a little bit. So what we did last fall is we did this project looking at all of these proposed crush plants, especially around Regina. That's going to be quite the gong show there on the highways, let me tell you. But anyway, that aside, it's going to be, so we looked at some yield scenario, or some production scenarios. And so what we did was we did a low supply scenario, which is this green, and then a medium supply and a high supply. And that was based on, two things, essentially, is acreage and yields. That's what makes up production. And so the low supply one, the difference between the low supply one, we raised acreage at 1% per year. We thought, okay, that's reasonable. And then on the high one, we raised it 2% a year. And the medium one, well, 1.5% a year. So not a whole lot of difference in terms of acreage. The real difference shows up when you start looking at yields and what the difference in the yields are. So we use different trend yields, and I think I need to flip forward a couple here. So what we did, so this chart shows seeded area over the last 20 years, and yields, which is the red line here, over the last 20 years. So it's kind of interesting that we had very, very steady growth in acreage, and well, apart from some real dips in yield, but that was still, the trend in yields was still very strongly higher. So the question is, when you do these scenarios and you try and look out 10 years or so on, what do you look at? What's the acreage trend that you use, and what's the yield trend that you use? So again, we used pretty small differences for acreage, but really there's been very, very little growth in acreage. It's been all essentially flat. And even yields, I mean, 21 really throws things off. But the trend yield, if you just do it over the last 10 years, has been pretty flat as well too. So it really hasn't, but if you take this, if you start your trend way back here and you draw it up to here, well then that's where you get this high supply, high production scenario. That's the yellow one there. And then the other one, the low one. So what you have is the outcome is that if you go up to 2034, which hopefully I'll be long retired by then, and then we have to answer for these numbers anymore. But what it shows is that we get production only up about 2 million tons from kind of the average, from about the 20 million ton average that we've had in a little while. The top end, we could get up to over 30 million tons. And so it makes a huge difference in terms of where where those supplies go and what kind of production and output that we have. This chart here shows over the last 15 years or so, again, crush is the blue lines. That had been trending pretty steadily higher as well too, and then exports had also been growing, but both have gone roughly sideways in the last 5 years. But what you had here is you had crush expanding. You'd have occasionally a new crush plant, but mostly it was through expansions to crush capacity. So someone would add, more capacity and so on. But suddenly, so the reality is that the market could adapt to these kind of changes. This type of change, where in a matter of 2 or 3 years, you add 5 million tons, 6 million tons maybe of crush in just 2 or 3 years, you got a lot of turmoil going on and a lot of excitement going on, trying to keep that supplied. And remember, the crush is your strongest demand, so they're going to buy what they need regardless. And so they're gonna buy the 15 million tons that they need. If there is a shortfall, what happens is then that exports drop off. And so exports, would as soon as this crush capacity jumps from here, you see exports dropping off. So exports to China and maybe Mexico, maybe Japan. But then you'll have these other countries. Remember I was showing you earlier how their production is trending higher. So they're going to step in and be exporting to countries that we used to export to. And it's not going to go away entirely. We're not going to lose all of that business, but it's going to take a hit. And then depending on how fast we can ramp up production, whether we can get these export totals back up to 10 million tons or higher down the road, that's going to be the pivot point in this outlook. So again, we've got this situation where it's questionable. And I'm not an agronomic person. I don't have those kind of smarts. So whether we can push yields higher is a really good question. The other question is where can we get more acres? So this table here shows, what I did was I ran canola acres as a percent of seeded area, of total cropland in different regions of the province. And so, you know the joke about, your rotation is canola, snow, canola, that kind of thing. Well, this area here in Manitoba, the regions 3, 4, 5, that's kind of up the west side. So like Dauphin area, from well, up the west side, and then but you've got all of that pull from the Harrowby crush plant, and then you got Yorkton across the line. You got that whole concentration of demand there too. So you have 57% in that one region anyway. 57% of the acreage is canola. So forget the one every 3 years or one every 4 years. It's one every less than every 2 years. And so that's the kind of thing that we have there. But even across kind of the northern tier of Saskatchewan, you've got roughly 45% of total cropland is canola. So there's not a whole lot of room there to increase canola in the rotations. What you have, though, is you've got these other areas where you've got where canola is less suited right now, frankly, and where canola is not as big a part of the rotation. So there you have some rotation room to boost canola acres, but it's going to be more of a challenge. If it hasn't worked there before, you need to either change farming practices or get varieties that are more suited there, or that's how you're going to get that type of movement in terms of acreage. So that's one of the things. So the highest percentage of canola is closest to the crush, where the crush is concentrated. And so, if you get a whole bunch of crush plants in Regina, close to Regina, that's going to be one of the areas where they're going to be bidding most strongly, and so it'll start to boost acreage there. So if we look at these types of things, so those production forecasts that I showed are highly variable, and so we tried to be conservative in those, but even then the outcome is pretty the spread in production totals is pretty wide. So there's modest opportunities for more acres. It's going to have to come more from yields. And I don't know, again, I'm not an agronomist, so I don't know how you do that. But I've been told that, yeah, there are opportunities to really do that. One of the things we did was we looked at some rural municipalities, and we looked at from crop insurance records, and we looked at yields from the bottom to the top in some of those municipalities. There's a huge range in canola yields in most of those, where the range could be 10 bushels an acre from top to bottom. So there is room to boost yields. It's just a matter of whether you can or not. So refineries alone are talking about adding 6.5 million tons. Yep, Don.
That last slide, where you got called
No. Sorry. There is a map. These are taken from the census, ag census, I believe, or those regions. So it would be one of the. I'm going to say it's in and around. Yeah, it's going to be around 30%. So 6 is Regina. So a little bit of room there. So refineries are saying that they're going to be needing 6.5 million tons of seed to match what they say they're going to do. And the refineries are the deep pockets behind this. So it's not like these are going to go away, because the refineries, so Imperial Oil just announced at Strathcona that they're going to have this refinery. So those are the deep pockets behind all of this. And of course, the Viteras and the Cargills of the world are no slouches either in terms of having money to do this. So it's going to happen. And so that's the kind of increase that we're going to be seeing. But we're also going to be moving a lot of canola across the border into the U.S. And a lot of canola oil into the U.S. as well too, because they have the same kind of legislation going on there too. And in fact, essentially this is being driven by these petroleum companies needing offsets to their carbon footprint. So that's what's driving all of this. And so in the U.S., they have these RINs, which are the carbon offsets, and they actually get more RINs back if they use canola oil than if they use soy oil. So it's actually to their advantage to use canola oil. So that'll help boost canola production there, but also drive demand of canola oil and canola seed from Canada into the U.S. And then exports get the leftovers. Whatever the domestic crush doesn't want, that's what's going to go export-wise. And then global production is going to increase to fill that gap in those other markets that still need it. A couple of other things. So the demand is being driven by oil. So canola is actually going to get closer links to what goes on in the energy markets once we really get into this. And so when ethanol, the ethanol thing was booming in the U.S., corn prices and fuel prices were doing this together. Not quite like that, but they were more closely linked. That's going to be a closer link. And canola and veg oils, soy oil futures are going to be a better indication of value of canola seed as well, too. Big one is, where's all that meal going to go? If you're someone who uses protein meals like canola meal or soy meal, you're going to be doing great because it's going to be priced at bargain basement prices. We're going to have, if we do 6 million tons more crush, that's 3.5, 4 million tons of meal suddenly that we have to do something with. And the U.S. market is largely saturated, and they're going to have way more soy meal of their own, so it's all going to go offshore. So China and other Asian countries will be able to absorb that, but they'll do it at a cheap price. So that's going to be a real outcome of this as well, too. And so I think canola prices are going to trade at a high level historically. Now, as my brother, the retiring farmer, said to me many years ago, he says, I'm not too worried about high prices. He says, because you get an extended period of high prices and then all of your costs do this too, right? And then your margins come back. So, it sounds great on the surface, but it's not going to be, there's going to be times where it'll work out really well, but there's going to be times where it's going to be business as usual. And then which crops are going to lose acres? And so that's one we don't have a really good answer for. There's going to be a few. We're already seeing some that are suffering. I think some of the pulse crops are going to suffer a little bit. Flax, those kind I think are going to be in tough. I think oats is actually going to hang in there. Not this year, but oats is going to hang in there because we've got all of these domestic mills now that are milling oats. And so just like the canola crush plants, has been demonstrated as really, really strong demand. So it's going to be kind of interesting. Any questions on the canola side before I jump into the barley? Yes. The question is whether the war in Ukraine, whether that's impacted the canola or rapeseed market. Actually, not all that much, no, because the Ukrainian farmers still kept growing canola or rapeseed, grew the same number of acres, and they planted about the same number of acres just this last fall. So that hasn't really changed all that much. And their market for that rapeseed is almost all Europe. So if they're trucking and railing and whatever more than they were pushing stuff through the Black Sea, they can still keep pushing a lot of that into Europe. So yeah, frankly, for canola, it caused a bit of excitement right on the first, but after that, it was kind of meh. And they've shipped basically all of their canola for the year already anyway. So they normally ship it all in August already because it's winter rapeseed. So August, September, October, November, essentially. By then, they've sold out. So there's nothing left for them to sell, but that's normal for them to do that way. It's specific. That's specific to canola. Yeah, because winter wheat acres, we already know that they've planted 40 to 50% less winter wheat than they normally do, like this fall. So yeah, that has a bigger impact on that portion of the market. Trying to get fertilizer into the country, wow! You thought you had troubles with fertilizer availability and pricing. It's just horrible there for them. So, and fuel and a number of other things. So yeah, canola would be probably one of the less affected crops that they grow. Okay, so we're going to do just a little bit on the corn side of the market before we get into the nail it down or drill down on barley. But what you have is U.S. corn ending stocks that. There's lots of questions about the USDA numbers every month and so on. But whether they bump it up a little bit or leave it the same, leave it unchanged, it's still relatively small ending stocks compared to the heaviness that they had earlier, where it was over 2 billion bushels that they were carrying. Now it's closer to 1.2, 1.3, somewhere in that ballpark. And so we're in a little bit of a different era, which means there's also less cushion for any kind of production problems when you're carrying over less supplies. There are questions about their pace of exports and so on, but still, it's relatively small. When you look at global corn balance, and so this chart shows the blue line is production, is global corn production, and then the red line is usage. And so you see that usage line goes up almost without fail every year. The only time that it drops or turns sideways is when there isn't production. Even that year, it still climbed higher, and it went sideways here, gone sideways a little bit. And then, of course, in this last year, we have a smaller global corn crop. A good chunk of that is Ukraine. A good chunk of that is Western Europe, the reason for that drop-off. And so what you have is, yes, usage has dropped off, but only because the supplies aren't there. What that means is that, and it applies to soybeans, it applies to wheat, is that every year we essentially need to grow, globally, we need to grow record crops every year just to keep the market supplied, just to keep up with demand. So when you hear stories about, well, it's record production, and it is, and we need it. The difference is when you get these little swings here, you know, like this year, or you had 2 or 3 years in a row, that's where it starts to get really heavy. That's when it hits the dumpster. But we really don't have any kind of cushion or spread here between production and supplies in this year. There's a lot of pressure on corn production in other than the U.S. Of course, we always watch the U.S., but there's other crops. So the Argentine crop, this estimate will likely need to come down because of drought there. Brazil has a bigger crop. Ukraine, of course, has a much smaller crop. And the one that I didn't put on the chart is Western Europe, where their corn crop was 15 million tons smaller than the year before. And that directly affects the barley market because Europe is traditionally a fairly sizable exporter of barley. But if they grew 15 million tons less corn, suddenly they need to keep more of that barley in their borders rather than export it. And so that's the situation that's going on there. But really, we need more production from these other countries, and it hasn't happened this year. Canadian barley production. So we'll get into the barley side now. So we had a pretty good yield this last year, right in around 70 bushels an acre was the prairie-wide average, according to StatsCan. And so we had a crop of about 10 million tons, which is pretty favorable. It's a nice sized crop, and yet prices only dipped very briefly in fall. After the crop came off, they did this, and then they started to do this again and go higher, and actually hit the highs that we had during the drought year. It's come off now since then, but that's the kind of situation that we have. So when we had the bigger supplies this year, then you also had more domestic feeding, which is the blue side there, but the exports were the one that have really been growing. And so we're really watching the exports. You'll see a lot of commentary about when you're talking about barley prices, about cattle going on pasture or coming off pasture, and the temperature is 5 degrees below normal, so therefore your feeding rates go up, and so you see lots of those kind of comments. Not that many people talk about the export side, which to me is kind of the extra thing that really pushes it one way or another, whether that demand is there. And so 90% of our barley, roughly, goes to China. This year we had a very strong, very good grade breakdown, good quality crop, and so you'll see that you'll sometimes see a quote that we need 20% of the barley crop to supply the malt side of the market. That's one of the worries. That's one of the concerns that I have, is that we probably don't. We've got more than enough barley to meet that kind of demand, but that demand, I think, is shrinking. So this is from the CGC, this Canadian Grain Commission. So they talk about barley milled, which is really malted. That's just their terminology. So it shows the green bars are this year so far, the weekly volumes that are malted. We're doing less per week than we did during the drought year, which is the red line there, and way less than the average. And so the maltsters that I talk to are really, really concerned about this. And it's not that this could be a longer term type of a thing. And really it's related to changing consumer tastes. So people drinking less malted beverages beer, and a few others, but drinking a lot more of the White Claws and the things like that. So there's a whole shift in changing consumer tastes that has the maltsters needing considerably less barley than they did before. And so when I talk to the maltsters, they say, yeah, we got coverage for the rest of this year. We don't need any more. We don't need to contract. We don't need to buy anymore. So that means there's probably not going to be a whole lot of opportunities for, to do new contracts for old crop barley, for this year's barley. So there won't be many of those opportunities. They have to keep their bid up or their prices up a certain amount, partly so that those contracts don't leak into the feed market. But otherwise, they say they're covered, and they have smaller contracting programs for next year. And so that's if you're growing barley, if you're growing malt barley, those contracts that are out there now, it may not take as long to fill them as it normally does. So something to watch out for. This is something that I got from the maltsters. So this shows over the last bunch of years how the U.S. beer market has steadily declined. It was up a little bit in 21, surprisingly, but it's really been trending down there. So it's not just a Canadian thing. It's kind of a North American thing that the barley market, that the beer market, the malt market is in a decline. Canadian barley exports so far this year. So we started off a little bit slow because we had no barley to export. But then it's really, really caught up. So what we had, this red line is the drought year. And we really ramped up exports really, really well. At one point, we were running at record exports for barley in the drought year. And then when we ran out, it just kind of, just turned sideways and we stopped exporting. Right now, we're kind of at that inflection point. We have bigger supplies, though, than we did last year. So there's room to do more, and I think we still will do more than we did in the drought year. But we won't do what we did this was the record year when we did 3.6 or 3.7 million tons of exports. So we're going to have a good export year, but not great. Essentially, though, this is the max that we could do in terms of exports. And so it's not like we have enough, we have too much barley, but it's going to be a little bit tight. But there are some risks in the outlook. So this is Chinese barley imports over the last bunch of months, going back to 2018. So you can see the red bars here are Australia. So they used to buy most of their barley from Australia, both feed and malt. They would buy that from Australia. Then in about May or June of 2020, things got a little testy between Australia and China. And you thought the tensions between Canada and China were bad. It was really bad there as well, too. And so China slapped on an 80% tariff on Australian barley. So that shut the door. So that's why you see these red bits all just drop off and then disappear. So then what you had after that is you had the remaining suppliers were Canada, Ukraine, France, and Argentina. So those were the four buyers for barley that China relied on for their barley. And then you can see over the months or over the years that as crops came off in southern hemisphere, Argentina, then they supply more, and when we ran out, then Canadian exports dropped off considerably. But really what's happened in this last year is there's a couple of things. One is that A, Argentina had a drought. B, Europe and France had a much smaller corn crop, so they couldn't export barley anymore, or not very much. You had Ukraine, which all of a sudden had their barley crop shut down to a large degree, a large chunk of it. Plus the shipping is more of a challenge. So that really only leaves Canada as a supplier right now for the Chinese market. So even though their total imports are down, Canada is still accounting for roughly the same monthly volumes that we did even when they were buying a whole lot more. So the size of the pie has shrunk, but Canada's piece of that pie is larger now. But it is iffy. If you look at Chinese grain imports over the last number of years, so this is corn, barley, sorghum, and wheat. And so you can see how it grew from 2019 to 2020 to 21, and then in 2022, this goes to the end of December, dropped off considerably from the year before. And that's related to issues related to the Chinese economy. But now that they're opening it up, we're wondering, are they going to start buying again at a quicker pace? And I think they will, is my opinion on that. These are grain prices in China, wheat and corn and barley. Barley is the purple line there. So barley was the bargain feed grain for quite a while, and that's why they were buying these big, big volumes. But because there just simply isn't enough available from all of these countries, barley has gotten relatively more expensive compared to wheat and compared to corn. So it's lost some of its attraction among Chinese feeders. So that's one of the reasons why the barley demand has slowed down. Just dialing back to the Western Canadian side of the market, this shows at Lethbridge, because that's kind of the benchmark market that we talk about, is you can see that the corn market has really kept feed barley and feed wheat prices from going higher. As long as corn can come in, and we learned that in the drought year, that there's almost unlimited supplies of U.S. corn, that we were able to bring that in. So all of those channels of importing corn are now in place, and it is still competing. So every time the Canadian dollar goes up a bit or corn futures drop a little bit, corn gets more affordable for Canadian feeders, and so we keep bringing in. So that's what's keeping really a lid on barley and feed wheat prices, frankly. By the end of this year, we're expecting, kind of like the canola picture, bigger, a little bit more barley ending stocks, but still very historically low. So that's kind of, it's going to be a tight-ish barley situation. These are barley seasonal prices, so what they do over the year. And boy, I wish I could figure this or wrap my head around this a little bit more. But why barley prices on a pretty regular basis tend to peak in June, July. And the peak is actually mid-July, which to me just doesn't make any sense. Somebody has explained it to me about feeding, and it's not just about cattle. I realize that. But it's, this is the type of a market that we've had. This was the drought year, so it really didn't follow that. There was never a seasonal or a harvest low in 21. But in 22, it followed that seasonal tendency pretty closely at a elevated rate. So that's kind of the seasonal price behavior. These are Canadian bids right now. So these are old crop malt and old crop feed bids, kind of the average across Western Canada. And these are mainly elevator bids with a few maltster bids in there. But then you have the new crop, which are these lighter lines, which have really been strengthening. The malt was really wonky here because, well, just because we only had one for a little while, then we had a couple of companies reporting and so on. But generally, some pretty strong new crop bids for both feed and for malt going into this, looking ahead to this fall. And so I think, to me, those look like good places to start. I mean, we don't tend to give market recommendations, but that's so we have. The real risk for the barley market, and it's a significant one. I'm not gonna downplay it, but the real risk is this trade dispute between Australia and China. And Australia has a WTO case against China over that 80% tariff. But they're talking, and they're expecting a ruling within the next 2 to 3 months. But they're also, the Australian and the Chinese trade ministers are starting to meet now, and not just over barley, it's over coal and wine and a few other things as well too. But they're trying to get things back on track again. And that's a real risk because right now, Australian barley is a bargain compared to Canadian barley. And so if that 80% tariff disappears, they're going to just switch whole hog into Australian barley. So that's a real risk for the Canadian barley market. So I don't want to say that things are rosy and they're just going to keep going higher. This is a real risk for the barley market. And Australia is pulling off about a 13.5 or a 14 million ton barley crop. So they grow more than we do. They export more than we do. They exported about 8 million tons last year. And so that's it. They're big, big exporters. So they have the ability to really meet that Chinese demand without too much difficulty. These are barley prices in Australia, so the malt, because they had that rain, they have a really huge malt premium right now, the malt versus the feed. But those feed barley prices are far below what Canadian feed barley prices are. This one shows it. So these are Australian feed barley prices. These are Canadian feed barley prices in Vancouver. So again, who's China? If they drop that tariff, who's China going to go to? It's pretty clear. So that is a real risk. For this next year, we expect maybe flat, maybe up, actually up a little bit for barley acres. I've heard people tell me, no, it's the opposite, it'll be down. That could be, but it'll be a crop similar size to the one that we've just had. But as we know, it's dry in a lot of areas still. There's lots of optimism, but it's still dry. This is at the end of December, so most of the western half of the prairies is looking at some vulnerable prospects, put it that way. So just to summarize that, we've got tight supplies globally and within Western Canada, but there's more substitutes in Western Canada. The imported corn, we've got a little more feed wheat than we did last year, so a few more substitutes there. The critical question is, what does China do? And I don't have a way of really gauging that. What I have seen, someone asked this question yesterday in North Battleford about China. What I have seen is that the Chinese officials are seem to be a lot less aggressive in their public statements. If some country annoys them or angers them or whatever, they're a lot less aggressive than they were, say, 6 months or a year ago. So maybe they're trying to be a little more friendly, which wouldn't be good for the Canadian barley market in this case if they settle their differences with Australia. So that's the real question. There isn't a lot of room for weather problems because supplies are tight, but that's the risk. So that's what I have for the barley market. And so if there's questions about that, or I've got time for a couple of other ones from whatever crops, I can try and do those too. Yeah, the low corn stocks, corn supplies, will tend to do that. It tends to be more related to the soft red winter, like the soft wheats. It tends to have more of a correlation there because that's more of the substitute. I'm not talking about wheat here, but I think our Canadian wheat has plenty of strength on its own. We're farmer deliveries of wheat so far this year are the fastest ever. You people are moving wheat into the system faster than we've ever done before. So just like canola and a little bit to the barley side as well too, is we're going to get some really, really tight supplies of hard red spring wheat as we get further into the year. So, even if futures continue to do this for wheat, the basis is going to improve as we get later into the year as well too. So I think the hard red spring side is less affected by corn, but it does have some spillover. One of the questions is, like the big thing about the wheat market, one of the big things is the state of the hard red winter crop, like Kansas, Oklahoma, Texas, and drought down there, right? And so one of the questions is if that crop, as it's coming out of dormancy, looks a little iffy, and corn prices are still pretty good, they're just going to till it under and put it into corn. So if we have a stronger corn market, then we take some wheat acreage out of the picture. That's going to be helpful as well, though, too. So yeah, there are effects. I wouldn't say there are none, but it's already looking good for wheat. Okay, well, I can talk to people as well, too. Some people like to ask questions off to the side, so that's fine, too. So thank you very much.